What if the biggest silver in the market right now is not about rising prices, mining shortages, or central bank demand? What if the real story is about pressure building inside the COMEX system itself? And what if Congress's historic Silver Act is suddenly becoming important again in ways most investors never expected? Welcome back to Pulse of Silver, where we break down the biggest silver news, market moves, and hidden financial trends shaping the future of precious metals. Today's topic is one that has silver investors talking across the entire market because many analysts believe the silver market is entering a very dangerous phase for paper traders and a potentially explosive phase for physical silver holders. For years, COMEX has been at the center of the silver market. It is the place where massive paper contracts trade every day, often representing huge amounts of silver that may never actually move physically. Most traders simply settle contracts in cash or roll positions forward. But recently, investors have started paying closer attention to physical silver inventories inside COMEX vaults. The reason is simple. The market is beginning to notice that demand for real physical silver keeps growing while available supply appears tighter than many expected. Now, when people hear the phrase Silver Act, they often think about history. The United States government has passed several important silver-related laws over the decades, especially during times of monetary stress and economic uncertainty. These laws were originally tied to national reserves, coinage systems, and financial stability. But today, some analysts are using the phrase symbolically to describe growing political and public pressure surrounding the silver market. There is increasing attention on whether paper silver trading has become disconnected from real-world physical supply. This is where the conversation becomes serious. Many silver investors believe COMEX operates smoothly only as long as most traders never ask for physical delivery. But if too many investors suddenly demand actual silver bars instead of paper settlement, pressure could spread through the entire system. This concern is not new, but it has become louder in recent months because physical demand continues rising from industrial buyers, retail investors, and even some institutions looking for protection against inflation and currency instability. Silver is no longer viewed as just a precious metal used in jewelry or coins. It is now a critical industrial resource used in solar panels, electric vehicles, military technology, medical equipment, and advanced electronics. As global industries expand, silver demand keeps increasing. At the same time, new mining production is not growing fast enough to match future consumption forecasts. This imbalance is creating fear that the market could eventually face a major supply shock. The reason people are connecting this situation to Congress and silver legislation is because governments historically step into commodity markets when financial stress becomes too large to ignore. During past monetary crises, precious metals became central topics in national policy discussions. Some analysts now believe silver could once again become politically important if shortages worsen or if public confidence in financial markets weakens. Meanwhile, retail investors are watching COMEX inventory reports more closely than ever before. Every time silver leaves registered inventories, social media explodes with speculation. Some investors believe this is proof that physical silver is becoming harder to source. Others argue the system remains stable and functioning normally. But regardless of which side is correct, one thing is clear: confidence matters. Once confidence starts breaking inside any financial market, volatility can rise very quickly. The silver market has always been smaller than gold, which means price moves can become far more dramatic when investor sentiment changes. If demand suddenly accelerates while supply remains tight, prices could move much faster than many traditional analysts expect. That is why some investors believe the current environment may represent the beginning of a major shift in how silver is valued globally. And perhaps the most important question of all is this: what happens if the public begins to realize that paper silver and physical silver may not be the same thing during a true market crisis? That single question is now driving one of the most intense debates the silver market has seen in years. Over the last several years, the silver market has changed dramatically, even though mainstream financial media rarely gives it serious attention. Behind the scenes, physical silver demand has continued growing while trust in traditional financial systems has weakened. Investors are becoming more concerned about inflation, rising government debt, banking instability, and currency devaluation. In that environment, silver starts attracting attention not only as an investment but also as financial protection. COMEX was designed to provide liquidity and price discovery for precious metals trading. In theory, it allows producers, traders, and industrial users to hedge risk efficiently. But critics argue that the massive volume of paper silver contracts traded every day has created a system where the paper market has become much larger than the underlying physical metal available for delivery. This is why many investors believe the market is vulnerable to stress if physical demand continues rising. One of the biggest concerns involves the ratio between paper contracts and actual registered silver inventories. Registered silver refers to metal officially available for delivery against futures contracts. Some analysts point out that the number of paper claims can sometimes appear extremely large compared to the available physical supply. This does not automatically mean the system will fail, but it does create questions about what would happen during a period of panic or sudden delivery demand. At the same time, industrial demand for silver continues expanding rapidly. Green energy projects around the world require enormous amounts of silver because the metal is highly conductive and difficult to replace in many applications. Solar panel production alone consumes huge quantities annually, and electric vehicle manufacturing also depends heavily on silver components. Technology companies, defense contractors, and medical manufacturers all compete for the same limited supply. This creates a situation where silver faces pressure from two directions at once. On one side, industrial demand keeps increasing because modern economies need more silver-based technology. On the other side, investment demand rises whenever economic fear grows stronger. If both trends accelerate together, the market could face a serious supply imbalance. Many investors believe this is why silver prices have remained unusually volatile. Large institutions continue trading paper contracts aggressively, while retail buyers focus more on accumulating physical coins and bars. This difference between paper trading behavior and physical demand has become one of the central themes in today's silver market discussion. The reference to Congress's Silver Act also reflects a growing belief that governments may eventually have to respond if precious metals markets experience severe stress. Historically, governments have intervened in commodity markets during crises involving shortages, inflation, or monetary instability. While no one knows exactly what future policies could look like, investors understand that silver has always carried both industrial and monetary importance. Another factor driving concern is global debt. Governments worldwide continue borrowing enormous amounts of money while central banks struggle to control inflation without damaging economic growth. In this environment, many investors see precious metals as a safer long-term store of value. Gold usually receives most of the attention first, but silver often follows later with much larger percentage price moves. Some analysts believe the silver market today resembles conditions seen before previous major rallies. Tight supply, rising investor awareness, industrial demand growth, and declining trust in fiat currencies are all appearing at the same time. Whether this leads to a massive price breakout or not remains uncertain, but the pressure building inside the system is becoming harder to ignore. The most important thing investors are watching now is whether physical silver continues leaving major vault systems faster than it returns. If that trend continues while industrial demand remains strong, the market could eventually face a moment where confidence in paper pricing mechanisms starts weakening significantly. And once confidence breaks, markets can reprice very quickly. One reason silver attracts so much attention during uncertain economic periods is because it sits in a unique position between an industrial commodity and a monetary metal. Unlike many other resources, silver carries both economic utility and historical financial importance. That combination makes it extremely sensitive to changes in global confidence, inflation expectations, and industrial growth trends. Right now, the global economy faces multiple pressures at once. Inflation remains a concern in many countries. Interest rates are creating stress across debt markets, and geopolitical tensions continue disrupting supply chains worldwide. These conditions make investors more interested in hard assets that cannot simply be printed into existence. Silver naturally becomes part of that conversation. But there is another issue receiving growing attention. Many analysts believe silver has been undervalued for years compared to gold and compared to its industrial importance. Historically, the gold-to-silver ratio has fluctuated dramatically over time. Whenever silver begins outperforming gold, it often moves aggressively because the silver market is much smaller and more volatile. This is why some investors believe silver could experience explosive upside if market sentiment changes suddenly. COMEX remains central to this debate because futures pricing strongly influences global silver prices. Critics argue that large paper trading volumes can sometimes suppress price discovery, especially when leveraged contracts dominate trading activity. Supporters of the system argue futures markets provide necessary liquidity and efficiency. But regardless of which side is correct, investors are increasingly paying attention to physical metal availability rather than paper volume alone. Another major development involves central banks and international trade systems. Around the world, countries are searching for alternatives to overdependence on the US dollar. While gold receives most attention in discussions about reserve assets, silver may also benefit indirectly from rising demand for tangible stores of value. Investors worry that persistent money printing and rising debt levels could weaken purchasing power over time. Retail investors have also become far more educated than in previous decades. Through online communities and independent market analysis, more people now track silver inventories, mining production data, and delivery reports closely. This growing awareness creates a market environment where sudden demand surges can happen quickly. Social media campaigns encouraging physical silver purchases have already demonstrated how rapidly public interest can spread. Mining supply adds another layer of complexity. Developing new silver mines takes years, requires huge capital investment, and often faces environmental and political challenges. Even if silver prices rise sharply, new production cannot appear overnight. Many silver mines are also byproducts of other mining operations, meaning silver supply sometimes depends on the economics of entirely different metals like copper or zinc. This supply challenge becomes even more important when combined with rising industrial consumption. Every year, modern technology requires more silver for advanced manufacturing. Unlike gold, much industrial silver is consumed in products where recovery and recycling are difficult. Over time, this gradually reduces above-ground availability. Investors who believe a major silver shortage is coming argue that the current pricing system underestimates future scarcity. They believe physical silver could eventually command a much higher premium if industrial users and investors begin competing aggressively for available supply. Whether that happens soon or years from now remains uncertain, but the possibility itself is attracting attention from both small investors and large institutions. The phrase "COMEX caught with Congress's Silver Act" reflects the growing feeling that silver markets may be approaching a turning point where political pressure, industrial demand, and investor behavior all collide. If physical shortages become more visible, governments and regulators may eventually face difficult questions about market transparency, inventory reporting, and the relationship between paper trading and real-world supply. And in financial markets, perception can sometimes become reality faster than anyone expects. The fear surrounding the silver market is not simply about higher prices. It is about what rising silver prices could signal about the broader financial system. Precious metals often move higher during periods when investors lose confidence in currencies, banks, or government policies. That is why many experienced investors watch silver not just as a commodity, but as a warning indicator for deeper economic stress. In recent years, governments around the world have accumulated enormous levels of debt. Central banks printed massive amounts of money during economic crises to support financial systems and stimulate growth. While these policies helped prevent immediate collapse, they also increased concerns about long-term currency stability. Many investors now worry that inflation may remain a structural problem rather than a temporary issue. Silver becomes attractive in this type of environment because it cannot be created digitally. Physical silver is limited by real mining production, refining capacity, and available reserves. This creates a sharp contrast with fiat currencies, where governments can expand supply rapidly through monetary policy. At the same time, trust in major institutions has weakened significantly among many retail investors. After repeated financial crises, banking failures, and market controversies, people are asking more questions about transparency and risk inside the financial system. COMEX naturally becomes part of that conversation because it plays such a large role in global precious metals pricing. Some investors believe the current system works normally and efficiently under ordinary market conditions, but may struggle under extreme stress. Their concern is not necessarily that COMEX will suddenly collapse tomorrow. Instead, they worry that a period of aggressive physical demand could expose weaknesses in how leveraged paper markets operate compared to actual metal availability. This is why delivery data now receives so much attention. Every time large amounts of silver leave vault systems, investors speculate about who is buying and why. Some believe wealthy investors and institutions are quietly preparing for future shortages. Others think industrial users are securing supply in advance because they fear rising prices later. Meanwhile, silver premiums on physical products have occasionally risen far above official spot prices during periods of strong demand. This gap between paper pricing and retail physical pricing has fueled even more debate about whether the market accurately reflects true supply conditions. The political side of the discussion is also becoming more important. Governments understand that precious metals markets can influence public confidence in national currencies. Historically, major movements in gold and silver often reflected deeper concerns about inflation, debt, or economic instability. If silver prices begin rising rapidly, public interest could grow very quickly, especially if shortages become visible at the retail level. That is one reason some analysts reference historical silver legislation when discussing current market trends. They believe governments may eventually face pressure to respond if the market becomes disorderly or if industrial shortages threaten economic sectors dependent on silver technology. Another important factor is investor psychology. Financial markets are driven heavily by confidence. As long as most participants believe systems are stable, markets usually function normally. But once fear spreads, behavior can change suddenly. Investors rush toward safety, physical assets become more attractive, and volatility increases sharply. Silver's relatively small market size means even modest increases in investment demand can have dramatic effects on price. Compared to global stock markets or bond markets, the silver market is tiny. This creates the possibility of rapid price movements if institutional capital begins flowing into precious metals more aggressively. For now, the debate continues. Some analysts believe silver remains heavily undervalued and could eventually experience one of the largest bull markets in modern history. Others argue fears surrounding COMEX and supply shortages are exaggerated. But regardless of where someone stands, interest in silver is clearly growing again. And whenever public attention returns to precious metals during periods of economic uncertainty, markets can become extremely unpredictable. The silver market appears to be entering one of its most important periods in decades. Pressure is building from multiple directions at once. Industrial demand continues rising because modern technology depends heavily on silver. Investors are becoming more concerned about inflation, debt, and currency stability. Physical silver inventories remain under close watch, while confidence in paper-based financial systems faces increasing scrutiny. The phrase COMEX, caught with Congress's Silver Act, captures the growing belief among many investors that the silver market may eventually face a major turning point. Whether that turning point arrives through physical shortages, rising investment demand, policy changes, or broader economic instability remains unknown. But what is clear is that silver is no longer being viewed as just another commodity. More investors now see it as both a strategic industrial metal and a form of financial protection. If economic uncertainty continues growing, silver could attract far more mainstream attention in the years ahead. During previous financial crises, precious metals often moved from being ignored assets to becoming central topics in global finance. Some analysts believe silver may be approaching a similar moment again, especially if supply constraints become more visible. At the same time, investors should remember that silver is also highly volatile. Prices can move sharply in both directions. Market sentiment changes quickly, and futures markets often create sudden swings that surprise even experienced traders. This is why understanding both the risks and opportunities is extremely important before making investment decisions. One major lesson from today's market is that physical ownership matters more to many investors than ever before. The growing focus on real metal instead of paper contracts reflects broader concerns about trust, transparency, and financial security. Whether those concerns are fully justified or not, they are clearly influencing investor behavior across the precious metals market. Another key issue will be mining supply. If demand continues rising faster than production growth, silver could face tighter market conditions over time. Industrial users may compete more aggressively with investors for available supply, especially during periods of economic instability. This could increase volatility even further and potentially reshape how the market values physical silver. For long-term silver supporters, today's environment represents validation of concerns they have discussed for years. They believe excessive debt creation, inflation risks, and dependence on paper financial systems eventually lead investors back toward tangible assets. Silver, because of its monetary history and industrial importance, sits directly at the center of that trend. Investors around the world will keep watching COMEX inventories, delivery data, mining production, industrial demand, and government policy responses very closely. Every new development could influence market sentiment dramatically. And if confidence in paper silver pricing weakens significantly, the entire market could experience a major repricing event. Thank you for watching Pulse of Silver. If you enjoyed this breakdown and want more updates on silver markets, COMEX activity, precious metals news, and global financial trends, make sure to subscribe and stay connected with the channel. This video is for informational and educational purposes only. Nothing discussed in this video should be considered financial, investment, or trading advice. Silver markets are highly volatile and involve significant risk. Always do your own research and consult with a licensed financial professional before making any investment decisions.